Hey everyone, welcome back to Corporate Decoder. Today we're diving into the latest filing from TriSalus Life Sciences, and trust me, it's more than just medical jargon. We'll see if this company is truly healthy or just has a good looking chart. It's the filing for Form 8K, which is basically a snapshot of important events. XD, the main news. TriSalus Life Sciences gave an update on their business and announced their financial results for last year that ended in December. Think of it like a report card after a long school year. Now let's get to the meat of the matter. They published a press release with these results. Don't worry, we'll break down what it all means. It's like turning a complicated recipe into simple instructions. Keep in mind that it hasn't been checked by outside accountants yet. Therefore, it might change a bit later. Articuda might change a bit later, or let's switch gears and focus on what they are selling. Their stock and warrants, which is basically giving the option to buy the stock later at a set price. They are trading on the NASDAQ under the ticker symbols TLSI and TLSYW. Time for a deep dive. I'm going to skip all the legal stuff and we'll scroll to the actual press release now. We get an update on their business, and it seems like they had some positive milestones in the past year. They talk about their work in liver and pancreatic cancer treatments using their TriNave and P-cell platforms. It looks like they are doing innovative work with ways to deliver drugs directly to tumors. But here is what we care about, the money. Let's check the financials. Looking at the balance sheet, they ended the year with about $34.2 million in cash. That's their safety net, the money they have on hand to keep things running. Now this is interesting. Their total operating expenses for the year were around $62.8 million. This is how much it cost to run the whole business, from research and development to sales and marketing. Compare that to the cash they have. That would mean they can keep running for about 6 months at this rate. And here's the bottom line. They had a net loss of about $56.4 million for the year. That means they spent more money than they brought in. It's not unusual for a company that's investing heavily in research and development like TriSalus. Let's quickly highlight some positive signs. For example, their research and development expenses were $23 on $7 million. It shows they are investing a lot in new technologies and treatments. That's where their potential for future growth lies. Now, let's step back and look at the big picture. TriSalus is in a tough but potentially rewarding field of cancer treatment. They're burning through cash, but they are investing in innovation. Their success depends on whether their technologies can make a real difference for patients and ultimately generate revenue. So, what's my take? TriSalus is a high-risk, high-reward play. They have promising technology, but they need to manage their cash carefully and show that their products can deliver results. If they can do that, they could be a major player in cancer treatment. Of course, there are risks. Developing new medical treatments is expensive, and there's no guarantee of success. They will face competition from other companies in the field, and they will need to navigate a complex regulatory landscape. Overall, TriSalus is a company to watch. They're not without their challenges, but they have the potential to make a real difference in the fight against cancer. Thanks for tuning in to Corporate Decoder. If you found this breakdown helpful, be sure to like, comment, and subscribe. Let me know what other companies you'd like me to decode next.